Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Along with my colleagues bringing a variety of perspectives, today I'll be talking about our recent upgrade of quality cyclicals and how it will be affected by the U.S. election and liquidity. It's Monday, October 21st at 11:30 a.m. in New York, so let's get after it. We continue to have conviction in our recent cyclical shift and financials upgrade. Indeed, cyclicals traded well last week as most economic data came in stronger than expected. It's worth noting we recommend investors stay up the quality curve within the cyclical space, however. While financials have been the best performing sector in the S&P 500 since our upgrade, institutional investors remain underexposed to financials based on our data, suggesting the sector can run further. In addition to better economic data, there are other factors affecting pro-cyclical stocks. We are focused on two in particular: the election and global liquidity. We believe a Trump win with a split Congress would provide a pro-cyclical bias, with small caps keeping pace with large caps. The markets seem to agree, with the recent cyclicals outperformance led by financials. Meanwhile, consumer stocks negatively exposed to tariff risks under a Trump win have underperformed. Interestingly, there is some overlap between this recent leadership and the post-Biden debate period in early July, as well as the months surrounding the 2016 election. Finally, we've also witnessed higher interest rates and a stronger U.S. dollar more recently, which is something to watch closely as a possible headwind for liquidity post-election and into 2025. While some argue a Trump win would be a headwind for growth in equity markets due to tariff risks and slower immigration, we think there is an additional element from the 2016 experience that's worth considering: rising animal spirits. More specifically, in 2016, Trump's pro-business approach led to the largest three-month positive impact on small business confidence in the past 40 years. It also translated into a spike in individual investor sentiment. It appears to me that markets may be trying to front-run a repeat of this outcome, as Trump's win in 2016 came as a surprise to pundits and markets alike. This also means a Harris win could lead to some reversion in terms of overall equity market performance and leadership. Most notably, bonds could potentially rally, with defensive and quality growth stocks doing better like earlier this year. Secondarily, even with a Trump win, certain areas of the market may be vulnerable to a sell the news phenomena if the upside's already priced amid bullish positioning. On this front, we would also point out that the economic setup today is very different than the 2016 period, when the economy had much more slack and could absorb additional pro-cyclical policies like tax cuts or other forms of fiscal stimulus. Turning to liquidity, we note that global money supply in U.S. dollars has surged at an 18% annualized rate since the end of June. I believe this has also had a positive effect on equity prices, not to mention credit spreads, precious metals, cryptocurrencies, and real estate. Bottom line, in the absence of a major swing in election probabilities or global liquidity between now and the election, equity markets are likely to trade with a bullish tilt, both at the index level and from a style, sector, factor standpoint. Thanks for listening. If you enjoyed the podcast, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.